This is Mark Warner with PropertyMortgageInvestment.com, here with another argument for Dave Ramsey. In an article that appeared in the Dallas Morning News, June of 2011, someone asked him the question, why do you only recommend 15-year mortgages? And Dave suggested that 15-year mortgages is the best way to go, and I beg to differ in terms of putting it down on paper and making sure people understand that there is an option and an opportunity if you do a 30-year mortgage versus a 15-year mortgage. So let me just give you the plain and clear numbers as how they appear to me. So let's take a $200,000 mortgage. Today's rates at par on a 15-year versus a 30-year, you can get a 15-year mortgage at 3.5%. versus a 40 or 30-year mortgage would cost you 4.375%. That's your interest rate. The payment on a 15-year would be $1,430 a month versus $998 a month on a 30-year payment. So the difference on a monthly basis is $432 a month that you would be saving if you did a 30-year mortgage. So if you take that $432, instead of putting it against your mortgage to get it paid off 15 years, and instead invested it every single month for the next 30 years at 7%, that's your time and your investment money. Versus the 15-year at $1,430 a month, there is no difference, but you have it paid off in 15 years. At the same 7% interest rate, investing $1,430 a month for 15 years, what's the bottom line? Well, at the end game, you have a home that's paid off after 30 years. So that's equivalent. But is the real number at the bottom line giving you the best deal? Now, one of the things I need to point out to you here is, why does the bank give you a lower interest rate on a 15-year versus a 30-year? Is it in your best interest, or is it in the best interest of the bank? Their risk is exactly the same when they initially loan you the money on $200,000. So, at the end of 30 years, the time value of money by investing $1,430 a month for 15 years, your total value with a home free and clear of debt is $453,256 versus investing $432 a month for 30 years. Again, you've got the home paid off, and the home's going to be worth what the home's going to be worth, whether you have debt on it or not. Has nothing to do with the amount of your payment. The time value of money is $527,027 at the identical interest rate over that time period. So the decision to do a 30-year versus a 15-year is not equal and costs you $73,771 to make the decision to go to a 15-year mortgage. So my two comments to you is, one, you can't eat sheetrock. So if you pay your home off and times get tough and we're in a turbulent time, you can't eat sheetrock, but you can certainly use cash to buy food with. And the bottom line is, cash is king, especially in this environment, and I would rather have an additional $73,000 to retire on than having a home paid off and $73,000 less. This is Mark Warner with my current argument with Dave Ramsey, and I'm with PropertyMortgageInvestment.com.